Hey, everybody, welcome back to Dental Unfiltered. I'm Matt Brown. I'm here with my normal, awesome co host, Dr. Andrew Vallo. And we're going to talk about a subject today. This keyword comes up so much, I'm sick of hearing it. We're talking about EBITDA adjustments. You cannot open a Facebook group, listen to a podcast, go to a dental event, have a conversation at a dental event, talk to another dentist, have dinner with somebody in dental, and not hear the term EBITDA come up. And it's probably the hottest keyword in dentistry right now is people saying EBITDA, which is really profitability, right? So Andrew, he's got a rapidly growing group, and a lot of people can, as they grow groups this rapidly, can lose control of things like EBITDA and overhead, really important things. And Andrew wants to talk today about adjusting EBITDA and kind of the frequency and kind of what his process is and how frequently he looks at it. So Andrew, you were inspired today to do an episode about EBITDA adjustments. Is this a new thing that you're just starting to do this way, or is this the way you've been doing it for a while? You can kind of like get into it for us.
So, guys, as Matt mentioned, I think that EBITDA is a term that's thrown around a lot. And I think a lot of dentists, either don't fully understand it or, maybe don't understand it at all. Because like, in all honesty, in the terms of just running the day-to-day dental practice, it's not something that's super important. I mean, it's something that comes up, when you're looking to potentially sell a group, especially if you're selling to DSO or private equity, because that's how they value dental offices. So if a DSO or private equity is buying a dental office, they're going to buy it for some multiple of EBITDA. And again, as Matt mentioned, EBITDA is essentially profit, earnings before interest, amortization, depreciation, taxes. But essentially it is how much profit did your dental practice turn out after all the overhead costs and after all the dentists are paid for their dentistry. So, essentially, and I think another term that's common is overhead. And I want to make sure this is clear to you guys. Overhead does not equal EBITDA. So, you often hear stats like the average overhead of a dental office in America last year was, 68%. It's often somewhere between like 65 and 72% is typically where the average overhead falls. Some are even higher than that. And then, when you join mastermind groups and you focus on your overhead, a good goal is 50%. If your overhead is under 50%, that's a strong practice. And some of the really mean and lean practices that, really are efficient with their dollars, they can get overhead down, 45%, 40%. Anything under 40% is pretty crazy, to be honest with you. I do know some docs that have done it. But again, overhead includes everything except doctor pay. So it's all the other expenses in the practice besides the doctor compensation. And something else you got to think about, if you're an owner doc who also produces in your practice, if you're not paying yourself the way that an average associate would be paid, you've got to adjust for that, add that cost, in whatever it is. So, let's go through some quick math. Let's say if you've got a strong practice at 50% overhead, that means the cost of all the stuff of doing business, aside from the doctor pay, is 50%. Let's say you're $1 million revenue practice. So you collected $1 million, 50% overhead means your cost besides doctor pay was $500,000. And then typically we're paying our doctors, around 30% of production. Let's say this was a single doc practice, and let's say that the doctor produced 900,000. Let's say it was, heavy doctor production, low hygiene. So hygiene produced 100,000. So now that doctor, let's make it even easier. Let's say this doc gets paid 33% of production. So 1/3. So the doctor produced 900,000. Their pay is 33% of production. That's 300,000. Overhead was 500,000. Doctor pay should be 300,000. Now, if you're the owner doc, you may have only quote unquote paid yourself, as a W-2, 100,000. That might be what your accountant said to do. It doesn't matter. You've got to normalize it. Again, normally you're somewhere in that 30 to 35% range. So, there's different ways we can slice that. But for this example, we're going to call it 33%. So 500,000 overhead, 300,000 is what doctor compensation should be at 33%. That leaves $200,000 there. That means that practice's EBITDA is essentially $200,000 or profit. But like, that's not the whole story. So that 200,000, that is unadjusted EBITDA. That is when we just take in the standard overhead, we take in the doctor pay, but we've got to then go and take a microscope to the actual overhead cost, because there may be some things that really shouldn't count against EBITDA. And typically that is things like one-time cost. So this is, and I'm going to kind of backtrack here for a second. This is not something I had been doing for my group up until recently, up until about 6 months ago. But I realized as you're growing, you really want to become more sophisticated. And honestly, this is something I should have done sooner. So, I'm not sitting here telling you, hey guys, when you get to 10 practices, you should start adjusting your EBITDA. I'm saying, going back in time, I would have done this probably at one practice, because it's a good practice to be in. It's good for you to truly know and understand your numbers. It's good for the bank, because if you can present clear financials, especially if you're adjusting EBITDA appropriately, in most cases it should make your practice more profitable, which should make it easier to get lending from banks. And God forbid you get in a situation where you do have to sell in a hurry. It's going to make it a hell of a lot easier if you actually have your current up-to-date numbers accurately adjusted. I started working with our CPA team on a monthly basis. And what I would do is I would go through our bank accounts. Once I kind of figured out what things I'm looking for with these one-time costs, I would go through our bank accounts. I would go through credit cards, and sometimes we kind of do it together on a Zoom call. Sometimes I kind of do it on my own, flag things, send them a list of, costs and dates and, time or dates and amounts and all that stuff. And then the CPA team would then take a look through all that stuff, and assuming they agree with me, they would then adjust it back to EBITDA. So basically, these are things that appear as overhead costs, but they're not in the normal manner of doing business. So, what would be like normal overhead costs? Normal overhead costs would be typical supply orders. Normal overhead costs would be things like rent. Normal, and there's fixed and variable, but these are all still normal. These are things that should reoccur on a regular basis. Marketing. I mean, you should be probably marketing every month. Unfortunately, I wish that was something I could add back to our EBITDA, because we market a lot, but it's not.
Wouldn't that be great?
Right.
Whoa, EBITDA just hit 50%.
Right. Payroll for your teams. That's normal. So like, what are some of these things that I'm talking about that aren't normal, that are one-time cost? Typically things like equipment. If you buy another dental chair and you pay cash for it, that's not something you're buying on a regular basis. That's something you're buying for like a growth expansion type of thing. That should be added back to EBITDA, because that's not a normal cost of doing business. Other equipment. If you buy a scanner, if you buy a laser, even a lot of small equipment can qualify if it's not something you're buying on a regular basis. So that would be like the main thing I would look for, would be equipment. Other things, travel. If you're traveling for CE business conference, especially if you're, and I'll be honest, guys, I've got my books super clean. Actually to the point where a lot of dentists probably would make fun of me. I don't put like, even like travel for like dental conferences, I'm typically putting on my personal cards. And the reason for that is, at this point, I've got a larger organization. I've got a partner. I've got some minority partners. So I really want to keep the books as clean as possible, where it truly is a business expense. But if you're the only owner in your practice, you're probably putting a lot of travel expenses on there, maybe some dinner expenses. They may or may not be ones that truly were a business expense, but even if they were related to business, that's usually something you can add back to EBITDA. Meals, travel, hotels, things that you don't really need to do in order to run your business on a day-to-day basis. So those are all add backs. Let's say you like buy new signage for your building. That would be something you can add. So honestly, there are a lot of these things. And, I'm not going to go through the list of every single thing that you can add back, but talk to your accountant about it. And if you've got a good accountant, they should understand this. They should know these things. They should be able to help you. And what I would recommend is, at the beginning, I would meet with your CPA, your accountant, on a monthly basis. I would together, pull up on the screen, bank account, credit card statements, anything that you're spending money from the business. And I would go line item by line item, and I would figure out things that you could and should probably be adding back to EBITDA. And if you do that for a few months, you're probably going to get a pretty good understanding of what you can. And then maybe you can do it on your own and not have to. Or on the flip side, if you don't want to be involved in this at all, you could just pay your accountant to go do that for you. But I'll be honest, your accountant may not always know what each, cost was for. Because a lot of times it doesn't say like, $2,000 handpiece. It'll say $2,000 Benko or Henry Schein. And like you have to know, oh yeah, I bought that handpiece. Is that something I can add back? So I do think it's difficult for the CPA to do it on their own. I think in the beginning, it's difficult for you to do it on your own because you don't know what truly is an add back. So I think to get at the beginning, you should do it as a team once a month. And then as you get more experience with it, you can probably do it on your own. Now, if you really don't want to do this, you really don't like it, could you have like an office manager do it? Yeah, probably. If you trust them, if you have them train with the CPA, if they really know the business and what expenses are, they could probably do that for you. You could have a spouse do it if you run your business with them. Honestly, this is something I kind of enjoy. Like we have a CFO, my dad, he's part-time. I'm trying not to add extra work to his plate. But like he could do this for me. But again, I honestly, I kind of enjoy it. In my mind, it's kind of like a video game. And I'm like, oh yeah, like I'm finding that, cheat code. I'm finding that thing. And all of a sudden our EBITDA is growing. So like I get joy out of it because I know like, hey, our business actually is healthier than it looked on paper. And this is my way of making sure that the numbers are optimized. It's not cheating the system, guys. It's not, you're not doing anything wrong. You're not artificially inflating numbers. Your numbers are typically lower. Your profit margin is typically lower unless you're not counting doctor compensation in there. And again, that's where people think that their EBITDA is 50%, their profit's 50%, but it's because they're not counting their own doctor compensation in there. So that's typically the only real way where EBITDA is artificially inflated is if you're not adding doctor compensation in there. Aside from that, EBITDA or profit is typically artificially deflated because there's a lot of quote unquote overhead expenses in there that aren't true. Now, again, this can vary office by office. If you're a younger office that's growing, typically there are a lot more one-time costs. If you're a group like mine, all of these startup costs for new offices, anything that we pay for, out of the business, that's a one-time startup cost. So, when we go back and look at like the previous year, there is a lot we're able to add back to EBITDA for these one-time costs, for startup costs, as well as additional equipment for offices, expansion. We've got 2 offices right now. Actually, we've got more than that, but we've got a few offices that are bigger layouts where we only equipped, certain rooms, and even some where we have to do a little bit of additional construction to open the other rooms in. So like those are all costs that can be added back to our EBITDA, added back to our profit. So again, guys, this may not be the most interesting episode to all of you. I'm sure some of you guys are listening, kind of geeking out about this because you enjoy the numbers kind of like I do. But whether you enjoy this or not, I do think it's important. Even if you have no plans to go to market, in the next 20 years, I think it's still extremely helpful for you to understand the health of your business, the profitability of your business. And I think it's even more important that you can show that you're a professional. Because if you want to go to the banks and ask for more money to do an expansion, to buy another practice, it's going to make it so much easier that you've got super accurate, and especially if it's timely. And so like what we start, and again, I think I talked about this maybe a little bit on the episode about making banks, making you attractive to banks. But since we started doing this, it makes conversations with Huntington a lot easier because I am literally on a month-to-month basis sending them an updated trailing 12 months with adjusted EBITDA where we're like, hey, maybe it's not 100% accurate. Like if you were to go to market and you've got, a broker going through things with a fine-tooth comb or whatever, or their team, their accounting team. but like it's probably 98, 99% accurate. It's very, very damn close. And I think it gives the banks another level of confidence in you as an operator in your organization to have timely, accurate financials on a month-to-month basis. So
I think there's like a cautionary tale here to be talked about. You know, Doc, if you're listening, I'm going to explain this. If you're listening right now and you don't know what your EBITDA is, I will guarantee you there's a whole lot of stuff in your business that you don't know about that you need to. And, it's Andrew's talking about this from the point of view of, if you're ready to sell, because Andrew's always like acquisitions, he's always thinking in that upper level. Doc, it's your pay. Like, it's your profit share checks. It's your distributions. Like, if you're not in touch with your EBITDA, like, you guys always want to track when you guys are an associate, you guys track your 30% of adjusted production, and you're asking all these questions. But then you get your own practice, and your EBITDA is the equivalent of that, and it becomes this thing that lives in a cloud somewhere, and you're not really in touch with it. So you're an associate, and you're going to the DSO you're working with, and you're like, well, 30% of my adjusted production, but I'm here, and it's like an every month fight. But then you own your own practice, and the equivalent is EBITDA, and you just stop paying attention to it. And forget acquisitions and stuff. That's your money. Like, if you're listening right now and you don't know what your EBITDA is, you are failing yourself.
No, I totally agree. So this was going to be a shorter episode, guys. I don't honestly have a whole lot more to say about the EBITDA adjustments. I mean, it's basically that's what it is. If you're listening to this and you're thinking like, man, I don't even meet with my accountants, or I just have taxes done once a year. Again, I get it, especially if you're newer to the business, if you got a smaller practice. At the same time, it doesn't really matter where you are at along your ownership journey. I think it's super important to have accurate data from day one. It opens so many more opportunities for you. It prevents problems like cash flow issues. I personally, and I'm happy to share this, I use Elliott Davis CPA Group. They're out of North Carolina. They're very good. I wouldn't say that they're super cheap, but they are dental specific. And I've been with them for almost 4 years now, and it has been overall a pretty good relationship. And they've helped me a lot. They've helped me grow, as a business owner. So there's someone you can have a conversation with. I would recommend them if you've got a couple locations. If you've got maybe like a mega practice, if you're looking for a true dental accounting group, I think they're good. I think it's probably overkill if you've got a single practice, but I would try to make sure you have a CPA that at least understands dental. I mean, it doesn't necessarily have to be a fully dental specific. No, but I think if they don't understand the dental field, if you're their only dental client, they're probably missing some things. And even if they're quote unquote cheap, it's probably costing you more money not having someone that's truly knowledgeable about it. So like, I wouldn't cheap out when it comes to things like attorneys, CPAs, consultants. I think it's worth spending a few extra bucks to get someone that truly understands, the profession that you're in. So just some food for thought, guys. I would consider, who are you using for accounting? Who's doing and taxes, man? You could be leaving so much money on the table if you don't have the right tax guy. So who's doing your taxes? Who's doing your kind of accounting monthly bookkeeping reporting? Are you working with them closely? Are they a good fit? Is it worth maybe talking to some other people out there? I would at least think about those things. And if you do feel like you've got a good CPA, that does understand dental, but you're not utilizing them the fullest. I mean, honestly, a lot of times, like, they're happy to meet with you guys. Like, I think my CPA group is thrilled. My team, I've got a team there at Elliott Davis, but I think they're thrilled that I've taken the initiative to start working with them on a month-to-month basis, cleaning up our EBITDA, because it makes they're not guessing anymore. It makes their job so much easier. So I don't think they're going to feel like you're bothering them or anything like that. I think they'll like the initiative. But I would have a conversation with them, see if you can start, having these meetings to kind of go through all of your expenses and start, making at least fairly accurate adjusted, EBITDA on month-to-month basis. get those trailing 12 months. Again, that's what the banks want. The banks want to see, what do the numbers look like for the trailing 12. They like tax returns too, but like this kind of keeps them satisfied in between tax returns. So I just, again, food for thought, guys. I understand it's not the most exciting thing in the world, and it's not going to like actually quote unquote add more revenue to your group, but it could show a healthier profit margin. It could actually overnight make your business more valuable if you can accurately calculate what your true EBITDA or profit is. So
awesome, guys. This is a short episode, but I think it's a really important message. You have to be in touch with your EBITDA. You have to be in touch with your numbers. It's your pay when you get down to it. Hey guys, thank you so much for joining us. Please hit like, subscribe, share, follow. Please leave a review. Me and Dr. Vallo love reading the reviews. It's our feedback loop, and we love hearing from you guys. Thank you guys so much, and have a wonderful day.